How can a strategy that wins only 51% of the time build one of the world's largest fortunes? The answer isn't smarter predictions, it's an industrial process that calculates mathematical expectation and compounds thin edges across millions of trades. In this deep quant analysis, we dismantle the machinery behind quantitative trading. We will show why data hygiene matters more than model complexity, how algorithms see stocks not as stories but as bundles of risk factors, and why execution cost is where alpha is truly won or lost. The goal is not to predict the future. It is to ensure that every time a set of conditions appears, the expected payout is just a fraction higher than zero. That fraction, repeated relentlessly, becomes an engine of wealth. At the heart of every quant system sits a simple equation. It multiplies the probability of winning by the average size of a win, subtracts the probability of losing multiplied by the average loss, and deducts all trading costs. The result is the mathematical expectation. If that number is positive, the trade goes in; if negative, it's ignored, no matter how compelling the story. This is not about being right most of the time. A strategy can win just 51 out of 100 trades and still generate enormous wealth if the wins are slightly larger than the losses and costs are controlled. The machine does not care about names, brands, or charismatic CEOs. It only asks, given this exact configuration of data, is the expected value positive? If yes, execute. Over 10,000 independent bets, the law of large numbers turns a tiny probabilistic edge into near certainty. The core challenge lies not in the formula but in estimating every input without fooling yourself, which is why data hygiene becomes the first true battleground. The difference between a retail trader and a quantitative fund runs deeper than technology. A retail investor typically buys a stock because of a compelling narrative, innovative product, visionary founder, or market-disrupting potential. An algorithm, by contrast, strips away all narrative. It sees every security as a stream of numeric returns and risk exposures. When a trade loses money, the retail mind often interprets it as a personal failure and may exit prematurely. The quant system logs the loss as a single data point and lets the next independent bet proceed according to the model's rules. This detachment is not emotional coldness, it is the engineering discipline required to let a small statistical edge compound. By accepting that losses are a pre-calculated cost of doing business, quant strategies avoid the behavioral biases, fear, greed, overconfidence, that erode most discretionary portfolios. The shift from asking, will this go up, to asking, what is the expected risk-adjusted return of this bet, marks the boundary between gambling and professional trading. Think of a manufacturing plant. The quality of the final product depends not on the brand painted on the packaging but on the raw material specifications, the temperature of the furnace, and the calibration of the assembly line. In financial markets, these underlying parameters are called factors. A stock is not a story, it is a bundle of sensitivities to systematic forces like changes in interest rates, shifts in energy prices, or broad market volatility. Two companies in completely different industries may behave identically if they share the same factor profile. That is why a quant algorithm does not care whether a ticker represents a soda maker or a software firm. It estimates the stock's loading on each factor and computes how that basket of exposures should respond to the next data release. If the current price deviates from that theoretical response, a trade signal is generated. This factor lens transforms asset pricing from a guessing game into an engineering problem of measurement and calibration. Before any factor can be tested or any signal built, the data must be cleaned with a level of paranoia that borders on obsession. Corporate actions like stock splits and dividends must be adjusted so that the price series reflects only market-driven returns, not artificial jumps. The most insidious errors, however, are temporal, accidentally letting information from the future seep into the training set. For instance, if a model uses a company's final annual revenue figure to predict its January stock performance, the backtest will be absurdly optimistic. The model will appear to have perfect foresight, only to hemorrhage money the moment it trades real markets. Finally, survivorship bias, the practice of analyzing only the subset of stocks that have survived to the present day, creates a phantom tailwind in historical simulations. The record of failure is as informative as the record of success, and deleting it is a guarantee of future losses. This chart illustrates the magnitude of the problem. The blue line represents a backtest that only includes companies still trading today, a sample that has been pre-selected for success. It shows a steady climb to a 22% annualized return. The reality, shown by the red line, is far more sobering. When all historical constituents, including the hundreds that went bankrupt or were acquired at distressed prices, are added back, the annualized return drops to around 10%. The gap is not a small rounding error. It is the difference between believing you have found a strategy with a 2.0 Sharpe ratio and discovering the true ratio is below 0.5. Every quant researcher learns this lesson. When a backtest looks too good to be true, the first step is to audit the data for survivorship bias and look-ahead contamination. Only then can you trust the signal. In a market with 3,000 stocks, each one produces a daily return. The resulting covariance matrix is colossal. Principal component analysis solves this dimensionality problem by identifying the directions that explain the most variance. The first principal component often moves exactly like a cap-weighted index. It is the market factor. The second component might reveal a rotation between growth and value, or between interest rate-sensitive and insensitive stocks. Critically, PCA does not require you to define these themes in advance. It lets the data speak. The algorithm then expresses every stock as a combination of these statistical factors. Instead of tracking 3,000 noisy series, a quant system can monitor just the top few components and their loadings. When a new macro report arrives, the system instantly recalculates the likely impact on every stock through its factor exposures. This is not economic storytelling, it is a signal processing technique that separates the music of systematic risk from the static of idiosyncratic noise. This table shows 4 components a PCA might extract from a broad equity universe. The first principal component mirrors the overall market. When it moves, almost everything moves with it. The second component often acts as a duration proxy. It captures the sensitivity of long-duration assets like technology to shifts in real interest rates. The third component can be dominated by energy-related names, reflecting the common shock of oil or gas price changes. The fourth component tends to spike during market turmoil, representing a pure volatility factor that affects assets with embedded optionality. The practical value of this decomposition is that a quant strategy does not need to predict the direction of 3,000 individual stocks. It only needs a view on a small number of systematic factors and an accurate map of how each stock loads onto them. When the map is precise, the idiosyncratic noise cancels out, leaving a clean signal. Consider Pepsi and Coca-Cola. For decades, their businesses have faced the same consumer trends, input costs, and macroeconomic forces. Their stock prices do not move in lockstep, but the gap between them tends to stay within a historical range. Algorithms exploit this through a two-step process. First, a cointegration test confirms that a linear combination of the two price series is stationary, that the spread always comes back to a long-run mean. Second, a hedge ratio is estimated by regressing the returns of one stock on the other. This ratio, often not 1-to-1, balances the volatility so that a long-short portfolio is market neutral. The system then watches only the spread. When Pepsi surges too far ahead of Coke, it sells Pepsi and buys Coke, betting that the spread will snap back. The direction of the overall market becomes irrelevant. The trade lives or dies on the persistence of the co-movement, not on any stock-picking genius. Because these relationships can erode, a merger, a sudden change in business model, the algorithm continuously retests the cointegration and stands ready to abandon the pair the moment the statistical foundation cracks. Once the hedge ratio is determined, the algorithm monitors the z-score. A z-score of plus 2.5 means Pepsi's price relative to Coke is 2.5 standard deviations above its historical norm. The algorithm interprets this as an extreme deviation and shorts Pepsi while going long Coke. The trade does not predict that Pepsi will fall or Coke will rise, it simply bets that the gap will narrow. When the z-score returns to zero, the position is closed, and the profit is the contraction of the spread. This framework is robust because it converts a directional problem into a convergence problem. However, it is not foolproof. The z-score assumes a normal distribution, but spreads can exhibit fat tails. During a market crash, correlations can go to 1, and both stocks may plummet together, blowing out the spread beyond any historical extreme. Risk management must overlay the Z-score strategy with a stop-loss that accounts for these nonlinearities, because mean reversion is a statistical tendency, not a law of physics. When markets are calm and the VIX sits near 16, as it did in mid-2026, the cost of trading is low. But when panic erupts, that cost can spike dramatically. The mechanism is adverse selection. A market maker's algorithm posts a bid at $100 and an offer at $100.02. If a large seller suddenly hits the bid, the algorithm infers that the seller knows something it doesn't. It immediately pulls its remaining bids and resubmits them at $99.90. The spread widens, and the seller receives a worse price. This is not predatory, it is a rational response to the risk of being on the wrong side of an informed trade. For a retail investor trying to exit in a hurry, the execution price can be far lower than the last screen price. The lesson for any market participant is that immediacy has a price, and that price spikes precisely when fear is highest. Patient algorithms that slice orders and wait for liquidity are often the difference between a profitable strategy and one that leaks its entire edge to the market structure. Quantitative managers live by the Sharpe ratio. It strips away scale and leverage to reveal the pure efficiency of a strategy. A strategy that returns 30% a year with 40% volatility may have a Sharpe of 0.7, while another that returns 12% with 10% volatility may have a Sharpe of 1.2, superior on a risk-adjusted basis. The Sharpe ratio also serves as a guard against overfitting. A backtest that shows a Sharpe of 3.0 over 10 years but delivers a 0.3 in live trading has misled its. The discrepancy almost always traces back to data mining. The model was fit not to a durable market signal but to the peculiarities of a single historical sample. This is why institutional quant firms run rigorous out-of-sample tests, paper trade the strategy for months, and only then allocate capital at a fraction of full capacity. The Sharpe ratio is the final arbiter, and a low live Sharpe is the market's merciless verdict on a model that mistook noise for signal. A complete quantitative system is not a single model but an assembly line of 5 interconnected modules. The data module ingests thousands of time series and scrubs them of biases. The signal module, often the most glamorous, uses the clean data to estimate factor returns and generate a set of score-rank trade ideas. But before a single order is placed, the risk module intervenes. It ensures that the portfolio is not a disguised bet on a single factor, even if the signals were derived from 50 different stocks. The cost module then calculates whether the expected alpha survives after subtracting the estimated transaction costs. Many strategies that look brilliant on paper die here. A 5 basis point edge that costs 6 basis points to harvest is a net loser. Finally, the execution module translates the portfolio into a sequence of child orders, hidden in the market, that minimize information leakage and impact. Each module is essential. A weakness in any one of them can turn a theoretically sound strategy into a money-losing machine. The final frontier of quant trading is execution. Even a perfect signal is worthless if the market moves against the trader during the act of buying. To combat this, execution algorithms break a large order into small pieces and feed them into the market over minutes or hours, closely tracking a benchmark like the volume-weighted average price. The goal is to make each child order look like noise, so that high-frequency competitors cannot detect the institutional flow and front-run it. In the fractured U.S. equity market, with over a dozen lit exchanges and dozens of dark pools, smart order routers constantly ping venues to find the best price while minimizing information leakage. The cost of poor execution can easily exceed 20 basis points on a round trip. At a portfolio turnover of 10 times per year, that is a 2% annual drag, enough to erase the edge of many strategies. Execution is not a clerical afterthought, it is the final gate through which all alpha must pass, and many strategies die at that gate. We have traced the path from a raw probability to a live trading machine. The core lesson is that quantitative finance is not a magic black box, it is an engineering discipline that demands rigor in data, humility in model building, and obsessive attention to costs. The 51% edge is meaningless without clean data. The Z-score signal is worthless if the spread no longer cointegrates. The Sharpe ratio is a lie if the backtest was contaminated by survivorship bias. And even a genuine edge disappears if execution leaks it away. For the disciplined investor, the quantitative mindset is the most durable advantage, define your edge, measure your costs, manage your risks, and let the law of large numbers work. Until then, always ask, what does the expectation say? Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.